Hello, hello, hello. How was the lunch, everyone? Was it good? Nice. Savory, Paro, Bowery, all really good brands. So I encourage you guys to look up their about them statement and the mission statement. They're all really good brands. So as everyone comes up, I'm just gonna wait for them to fill out the seats a bit. People are still chatting downstairs, so yes. This panel that we have coming up is where does D2C go from here? Really interesting topic. Even some can say a little bit, controversial so in some aspects. But yes, so we're very excited to have this. We have Andrea here from CPDG. We have Suze Dowling from Pattern Brands. We have Gabi from Magic Spoon, and we have Mike from AMPLA. So I'll have them, sorry guys. I'll have them all introduce themselves very soon. And let's give it a minute as people are coming up. And yeah, thank you guys. All right.
Get comfortable. How long is this, 30 minutes?
Okay, great.
Have them up here. I was just looking at them. I mean, is it bad to hold my phone open?
I think so.
Okay.
You guys want to test your mic
Yes,
real quick?
moderator.
All right,
I'll
we're
do
good?
that. I'm gonna
All right.
do that then. Ooh, man.
All right, let's get started. You good?
Oh, okay. All right, we're gonna get started with this panel now to talk about what the future of D2C looks like. Just to start off, I'll preface with my own intro and then I'll leave it to the panelists. But my name is Andrea. I am the CEO of CPGD, which stands for the Consumer Packaged Goods Directory. I write about consumer brands, and I write about a lot of the people sitting here and in the audience as well. So I would love to hear from each of you about kind of what you do and just maybe a brief introduction from each of you.
Well, thank you for having me. So I'm Suze. I'm co-founder of Pattern Brands. So we are a portfolio of brands focused on enjoying daily life at home. So 6 brands in the family currently, including Open Spaces, Gear, Letterfolk, Onsen, and a couple of additions. And then prior to that, I was a partner at Gin Lane, which was a branding agency here in New York for many years that helped launch a number of brands to market, including Sweet Green, Harry's, Hims, Stadium Goods, and others. So excited to be here today.
And recent speaker at Harvard Business School.
Life dream come true.
Hey everyone, Gabi Lewis, founder of Magic Spoon. We make high-protein, low-carb breakfast cereal that tastes like your childhood favorites. We launched 4 years ago direct-to-consumer, and we are now found in Target, Walmart, and about 10,000 stores across the country.
And my name is Mike. I'm the head of marketing at AMPLA. We are a fintech lending platform and banking solution for consumer brands. Prior to that, I was the co-founder and CEO of Gravity Blankets, the weighted blanket brand, and happy to be here.
All right, super stacked panel here today. Super honored to be talking to you all, and I think this is the perfect group to be talking about this topic, which is where we're seeing D2C going. So would love to just hear, maybe starting with Suze actually.
Putting me on the spot.
Putting you on the spot here, but would love to hear about what changes you're seeing in D2C today, especially seeing as your company is acquiring these brands that sometimes have an omni-channel approach, so you kind of see both sides of it.
I mean, I think one of the changes has honestly been the rise of omni within, what were traditionally D2C brands. I'd say the other evolution that I'm really seeing is the power of AI and how that can really impact our approach to personalizing the consumer experience, not to mention honestly some of the back-end operations as well. And then I think the other themes that are not necessarily new but continue to remain true are really thinking about supply chain and kind of transparency and sustainability there, alongside just really how you create this best-in-class consumer experience.
Definitely, I love that you mentioned AI, especially because I think that has contributed so heavily in D2C, but now we're seeing it also contribute to the operations and logistics of retail and in person. And then Gabi, being that your brand, I think, started in D2C. Yeah, how was your perspective been on the D2C landscape?
Yeah, I think at the most basic level, the origins of DTC were it used to be cheaper to pay Facebook to show up in the aisle that is the feed than it was to pay Walmart or Target a margin to be in the aisle that is the store. And that's no longer true. And so every channel, whether it's Facebook, influencer marketing, it's no longer cheaper to get in front of a consumer in that digital world than it is in the physical world for most brands. And so that's feeding through into the move towards omni-channel, diversification of channels beyond just Meta, Facebook, Instagram. And that's also related towards a shift towards efficiency, profitability, and of course the funding landscape getting harder for D2C brands because of that increase in costs.
I hear funding, and I would love to hear from you, Mike, about your perspective on that.
Yeah, the fundraising landscape has obviously gotten incredibly tight, and I think there's now even a conversation as to whether consumer brands of today are even venture backable. So we've seen quite a bit of folks turning to debt solutions like AMPLA, venture debt, and there definitely are follow-on rounds happening for brands that have already raised. It's just been very, very tough for new brands to sort of realize the horizon that VCs are typically looking for. So there's certainly opportunity for angel rounds, friends and family rounds, but it's that traditional VC game has changed quite dramatically.
I couldn't agree more there. I mean, one of the reasons we started Pattern, which is, multi-brand, was because we saw that it was really problematic for singular D2C brands to really be VC-backed. And so it's interesting, while we are VC-backed, I'm such a proponent of looking at alternative financing solutions and trying to really bootstrap as long as you can, because for us, we acquire people's brands. And so all of the businesses that we've acquired have never raised $1 of institutional funding, and yet they're able to have a really healthy exit that they're incredibly proud of and that can be life-changing.
What are some of the differences between a venture-backed business and a bootstrap business that you've noticed and that open to all of you?
I think it's really the fundamentals of good businesses, right? Because I think so often, and if you look at the last decade of D2C, there was just so many checks being written, honestly, based on ideas versus reality. And so there was so many businesses that were growth at all costs, but with zero path to profitability. These days, and I still believe venture dollars are obviously still going into consumer, but I think you really need to have a very, very solid business that has strong gross margins, it is profitable, you have the loyal consumer, et cetera, and that's really what's going to sustain you.
100%. Any thoughts on that?
Yeah, I totally agree. I think so. We've raised about $120 million over the past 4 years, and it's neither good nor bad, but it creates different expectations for what you need to accomplish. So after our 2 years in D2C, when we were thinking about going into retail, we have investors that have certain expectations, and so that meant, as much as I love Whole Foods and Erewhon, it wouldn't move the needle. It wouldn't get us to our goals or our investors' goals. And so that kind of narrowed our path of options to some degree. And that's one of the many factors why we decided to go into Target and Walmart as our first retail partners, rather than starting small and more regional. And again, there's pros and cons to both paths. I think for us, we're entering an enormous category which is dominated by 3 massive cereal companies. And we want to be the dominant healthy option. And so we deliberately chose to do that. We wanted to raise a lot of funding so we could compete with marketing and everything else, product innovation. And we deliberately set ourselves in this path, which is not the right one for every company, but it was one that was very purposeful for us.
Yeah, and I would say there's also a very distinct difference between the types of executives that are managing these businesses. For Gravity specifically, we did not raise funding, and that meant that me as a CEO, I was able to really focus on I did mostly sales and product development, whereas at AMPLA we have raised quite a bit of money, and our executive team spends a lot of time preparing investor decks, follow-on rounds. It's just a different skill set, I think. So you'll find, I think, differences in just the way those businesses are led.
What are the 1 or 2 metrics that you track most often that you find most important to business growth? And maybe has that changed over the last 5 years?
From my perspective at AMPLA, when we're evaluating companies to provide capital to, we don't necessarily require them to be profitable at present, but certainly a clear path to profitability, and then healthy runway is the other thing. So if generally if the unit economics don't make sense, or they're dramatically negative contribution margin from the start, it's just going to be very hard to conceive of a situation where they'll be able to turn that around, even with tremendous scale.
Yeah, for us on the direct-to-consumer side, it's blended cost of acquisition. So we don't actually pay too much attention to what it costs us to acquire a customer through Facebook or podcasts or influencers. The customer journey is not that simple, right? Somebody hears you on a podcast, but then maybe they see an ad, and then maybe their friend tells them about it. And so we don't really pay too much attention to channel CAC. We look at overall blended CAC as our main KPI on the direct-to-consumer side of the business. And then on the retail side of the business, we look at average velocity. So we don't care as much about our absolute revenue in retail stores. We care about what is our dollars per SKU, per store, per week, and how does that compare to the competition? Because what we're really trying to do now is prepare case studies to scale further. So we want to be in, for example, 1,000 Walmarts, crushing it, and then taking that data and taking it to Costco, to Sam's, everywhere else, and scaling the business, rather than being in 4,000 Walmarts, maybe doing higher revenue, but not doing quite as well per store.
I mean, that was so well said.
Yeah. And what do you think is the kind of you mentioned profitability and CAC. What are the biggest roadblocks to achieving stronger CAC and stronger profitability today in D2C, and how can brands navigate that more effectively?
I mean, one of the bigger challenges is just the cost of goods are so high right now. I mean, inflation is coming down, but we're seeing elevated costs, which means that brands have to discount less or make harder decisions when it comes to promotions, which then affects overall revenue. So it's just a lot to balance as it pertains to like the pure cost of goods when it comes to margin.
I think just building on that margin point though, something we've really learned was the importance of really thinking about your long-term sales channel strategy when really developing the product day one. Because you really need to create a product that does have like the fully loaded gross margin to be able to allow you to succeed not only in D2C, but also as you approach a number of these wholesale partners and their margin expectations. And so I think if I could give myself advice when we were first incubating open spaces, it would have been to really understand that and honestly create a lot of the products differently, because otherwise you have to go and re-engineer in order to be able to allow you to have the margin to scale in wholesale.
Yeah, I think that's so important. Like if you have a $20 food product that's consumed twice a month, it doesn't matter what your CAC is, and it doesn't matter how good your growth marketing team is, that business is not going to work direct to consumer. And so if that's what your product is, you need an omni-channel approach from day one. Conversely, if you have a food subscription company, HelloFresh, where someone's consuming it twice a day, it's very habitual, they're going to last 6 months, 12 months, that makes sense for DTC, and then you can think about CAC and LTV and everything else. But it starts prior to that. It starts with the product and setting everything up so that D2C can work in the first place, and having an average order value and a lifetime value so that you can then start thinking about CAC.
Gabi, you mentioned having high velocities, and I know that succeeding in retail takes more than just like signing the dotted line. So how do you really succeed in retail? What kind of relationships do you have to form with the buyers or whoever's there, and what can other brands do to achieve success there?
Yeah, so our approach was a little bit unique because we spent 3 years direct to consumer before we entered retail. And so that enabled us to build up this sort of groundswell of demand such that when we put it on shelves, we were confident that the pool was going to be there. But I think that the philosophy still applies, that your goal is to create some kind of case study to then take to other bigger retailers and just scale outward and outward and outward. And so if you can go to Target and have them be your case study, fantastic. But if you can't, then maybe it's one region of Whole Foods, maybe it's 10 local stores in New York that you give them a few bags of your product and you give it to them for free, but you say you're going to come back next week and ask for the money then, or whatever it is, like hustle to do it. But you take that case study and then do something double the size, triple the size. I think that's the key to sort of ultimately scaling retail. It's taking something small and just building outward and outward.
And I think building on that thought, you really don't want to do it too early or before you're ready, because I think there's a couple of things there. One is if you go into, say, something like Target too early and you're not prepared for that and you don't have the velocity, your case study and opportunity is gone. So it's start small and build from there. But also, in going into retail, you no longer are in full control of the consumer experience. You no longer have all of the consumer data at your fingertips. And that is like the power of D2C, right? And so I think it's all a trade-off about when the right time is for your brand, and it's going to be different for my brand than it may be for your brand, because it is so specific to, you know, the individual business case.
Yeah, I would say like the biggest thing is like understanding that you can say no to a buyer. Like being pushed into a national rollout is probably the worst thing you could do. If like sitting on shelf is a #1 way to get like never get that opportunity again. We did a lot of things wrong at Gravity, but one thing we did right is we said no to a full fleet rollout and did like, all right, we'll take 700 stores or 500 stores, I forget what it was. And that ultimately was a much better decision for us than to say like, of course I would have wanted that revenue for the full 2,000 doors, but it just wasn't gonna be a success for us.
Because it's all about a long-term relationship. It's not about like an in and out buy. You want someone that's going to come back, and you're creating a win-win situation where then they come back and they buy again and again and again, because ultimately they care about performance on shelf.
Do you find that before you're in retail, having venture capital funding does help with those kinds of conversations with buyers? Or like, what are some of the things the buyers are looking for when you're having those first conversations?
It depends so much on the buyer. You know, we run some TV ads, and we actually concentrate them in areas where Target headquarters are and Walmart headquarters. And so our buyers at Target and Walmart, before we were in there, like they heard about us from their kids seeing a TV ad, for example. And so it's like, that's obviously like a luxury we have to be able to run TV ads, but it's finding a way in to sort of get their attention that's different from just a cold email. If you can't think of a way that's different from a cold email, like the classic move that I always play is just getting the buyer's email and saying, hey, I'm in Minneapolis next week, can we grab coffee? And if they respond, then you fly to Minneapolis, and if they don't, then you don't. But finding a way to like make it casual usually helps. So I've always found that trying to get coffee or get a drink with the buyer, they're more likely to say yes if they think they're not being sold on your product, even though they're 100% being sold on your product. But if you can sort of make it a little bit more fun and casual, that always helps.
I mean, it's all about the game of a relationship. You know, it really is. It's two humans working with one another, and how do you build that relationship and rapport? We've actually had really good success like with cold LinkedIn reach outs, in that I get most of the emails ignored, but LinkedIn, if I can hit them up and send them like a kind of mysterious message, I've been told that it's intriguing enough that they'll respond back. And interestingly enough, kids is a good one, in that I had a buyer write back to me the other day saying, oh, actually, my kids love your glow-in-the-dark straws. And I was like, okay, I've got you now. So you've just got to find what that angle is and kind of build that connection from there. I also think, you know, use what you have to your advantage. So if it's you have a really unique product, make sure they're aware of why it's unique and why it's best in class. If you have an amazing social following that, you know, for us, some of our brands have had some really viral moments. Again, lean into that, because people want to be around things that they think will be really successful and meet their consumers' needs.
I love that. I think every founder has moments of like, this is how we hustled our way into Trader Joe's, or this is what we did to get into X, Y, and Z. I'm working with a beverage brand right now, and they were saying how they're actually scaling back from retail, even though they were in all of these thousands of stores, because they said succeeding in retail is just so hard. You need so much money. It's actually better to start in D2C and work your way to retail. I guess, what are your thoughts on that, and how traditionally maybe the model has been start D2C, then go into retail, versus retail to D2C, and what do you think is the proper way to go about it? Does it depend on the category?
I think it does depend on the category. Like, I think it is very much category specific. Is this something where people need to touch, feel, taste it in real life? Or is this something that also can be successful on D2C? I will say for us, like, one of the things that, you know, coming from a world of D2C and then, you know, expanding into wholesale, was just really realizing the payment terms. You know, if you get a $2 million PO in, you're then producing that probably 9 months ahead of that landing, and then there's another net 60 on top of that. So really this is all about like cash to cash cycles that can be pretty challenging, especially as you're really quickly scaling.
Yeah, I also think the grass is always greener. So every time I talk to a D2C brand, they're like, oh, I cannot wait to get into retail, CAC is killing me. And every time I talk to a retail brand, they're like, oh, D2C must be so nice, it's so easy, you just put an ad on Facebook and it's just like that. And so it's all really hard. I don't know what the beverage brand is you're referencing, but there's very few D2C beverage brands because shipping liquid is expensive. And so I'm not sure there's very many case studies of at-scale successful DTC beverage brands. Maybe Soylent a few years ago, but they don't even do DTC now because it's so expensive to ship. So beverage is really hard and expensive, both online and offline. Yeah.
Yeah, I would say across our portfolio, food and bev is the biggest category, and I would say 100% of them are omni-channel. We have very few solely direct-to-consumer food and bev brands, and frankly, like very few pure-play direct-to-consumer brands in the portfolio at all. I mean, some have higher concentrations than others, but I would say 90% of the brands are omni at this point.
I would love to hear about also kind of influencer partnerships and creators and how you work with them and how you think about also financing with creators and potentially even giving them an equity component. What are your strategies around that, and how have you seen other brands leverage creators and influencers to grow their brands?
Yeah, so we've done a couple of things. At the very beginning, we actually raised our first $1 million all from influencers. So we took like $10,000, $20,000 checks from health and wellness influencers, probably 50 of them, and they were the majority of our pre-seed financing round before we launched. So they were literally, invested in the business. And then we took 2% of our business and we set that aside as a bonus for the best performing influencers and promoting our products when we launched. And so for the first 6 months of our business, almost all of our sales were driven by these influencers. There were investors in our business, and then we're getting bonus equity if they basically won this sort of competition we structured amongst these influencers. So that was what we did at the very beginning. Now we have a more traditional approach where we're mostly paying sort of mid-level influencers, usually like 50,000 to 1 million followers. And I think the biggest piece of advice is never take a gamble on an influencer because the performance is so erratic and you want to minimize the number of misses. So whenever we're working with an influencer, we're always talking to other brands and seeing what was the performance, like the measurable ROI, dollars performance of other partnerships they had. And influence is also the one area where we still work with agencies for a similar reason. So we can work with an agency and they've worked with a certain influencer across 20 brands, it massively de-risks it and minimizes the probability that we're going to work with an influencer that costs a ton of money and doesn't perform.
I'd say that there's like just setting your expectations for like what certain influencers can do and what they can't do. Like some are always going to be good at just building general awareness, and then some are like really good at selling. And I would also ask for like, are they interested in affiliate revenue? Because if they say yes, that means that they can sell and they can make real money off that. So it's about like understanding what they can do and what they can't do, and certain ones are better at other things than others.
I also think, don't forget about the nano and micro influences. There's a lot of power in just organically gifting these folks and creating that awareness. Again, it really depends on your COGS and if you can afford to gift en masse, but if you can, like that, there is a lot of power in doing that, and I'm also a huge believer in affiliate. For us, we've really honestly steered very clear of actually paying influencers for coverage. We will pay content creators if they're creating ad assets that we're using, but it's been kind of a line in the sand that we haven't yet, stepped over. We've also looked at, do we kind of raise, money from a celebrity or influencer on the cap table? The problem I've had is just the amount of kind of equity that they would take doesn't necessarily make sense for the value that they would drive, which I think speaks to the point of being really data-driven, just like you should be in any other part of your business.
It's a great idea to actually ask about affiliate. How are we doing on time? Are we good for?
We're good. I just want questions.
Questions. Great. Let's open it up to the Q&A. Would anyone like to? I see a hand.
All right. Introduce yourself and then speak into the mic.
Okay.
Hi guys, my name is Emma. I'm the founder of a affiliate marketing agency called Praise. We specialize in PR, high quality content affiliate partnerships. I wonder what you guys think about when PR and communications is top of mind. Do you want press to direct to the DTC site? Are you okay with them directing to retailers? It's always a push and pull with some of my clients. And I know PR is a huge channel for a lot of brands, whether you are retail or strictly D2C. So I'm just wondering what you guys think about that.
At Gravity, we had a lot of success like getting the buyers excited about giving, like when we would do an affiliate post for like Black Friday, giving them that placement for Target, for example. And that was sort of just like value add because we had an affiliate agency on staff and I could get them excited that we were gonna do our share of the marketing as well. So it was sort of like a tactic to get them excited about any promotion, and they could maybe even kick in some value out on their end. So that's how I would think about it.
I agree with that. I think it's pick your moments of the year and then make it very clear to the retailer that you're doing this for them so that you get the credit for it. But I think on a day-to-day basis, you should be really pushing to D2C, again, to get that consumer data, but have those big moments where you can really win with the retailer.
Great question. Anyone else?
Hi, my name is Andrea, and I'm the co-founder and CEO of Grillo. So we're an online curated marketplace for inclusive artists and indie brands, and I've been doing that for the past 2.5 years. I'm sure you guys know marketplaces are really hard, so we've been, everyone nods, we've been pivoting to create our own product development line of tone inclusive pimple pouches. So we've been working on that for like the past 1.5 years now. And so we're at this kind of point now where we're trying to figure out what line of fundraising do we want to go to, if we want to go the Kickstarting route, which is community-based, or if we want to go the VC route. I'm sure you guys have a lot of opinions on this. I just want to know what you guys think of what the two funding options look like in the beauty brand.
Thank you.
I can speak to this. Gravity was kickstarted, so we raised $5 million on Kickstarter, and that was the only money we raised. I will say a lot of it was off the back of like really cheap Facebook ads. So that was the primary driver to the Kickstarter. I don't know how effective that would be these days. And I also wonder how big, like at the time, that was not even like one of the bigger raises on Kickstarter. It was like up there, but there were ones that were doing like $10, $15 million. I wonder if you're still seeing real volume on Kickstarter. I'd have to check out. But I mean, I like it. If you could swing it, it's worth a shot for sure before you really start kicking the tires on institutional capital.
Yeah, I mean, I would maybe do them in parallel and sort of explore. I think to do a really successful Kickstarter that raises like real money is hard. Like maybe more hours going into that than the actual VC fundraising, potentially. We did a Kickstarter in my last business, and it took far, far more time than some of the actual investor meetings did, would be one piece of advice. And then I also think it depends like what you want for the next few years as well, right? Obviously bringing in VCs comes with expectations and strings, and you're sort of on a path and your options are narrowed. You know, it's harder for you to pivot again if you decide that the idea you're on right now isn't quite it. Whereas if you do a Kickstarter or friends and family, like you maintain optionality. And so if that's important to you, then that would be a reason to maybe do that path.
I think it also just depends how much do you need to raise and like what are you raising for? Because I think they are two very different paths. And likewise, then there's the angels and friends and family route that you can go.
Any more questions for the audience?
My name is Andrea. So I think someone mentioned earlier, said that when we're rolling out the product, it's better to go in smaller increments and then larger rollout. So my question to you is, are CPG companies thinking of different ways today to get their product specifically to their customer or potential customers? So we talked about DTC, we've talked about maybe retail or more cardio. What's the new up-and-coming way to experiment how to get the product to the customer? If there is one.
I've seen a lot of like marketplace approaches on other brand websites. So like there's a platform that we're friendly with called Canal. It essentially allows you to start selling other people's products on your store. So if there is a store that's getting more traffic than you could essentially approach that brand and be like, we might be a good fit if you want to start building out sort of non-owned products. There's a lot of crafty ways. I don't know if that's going to ever scale to the place that you want it to be, but it's certainly a path.
I think also, like obviously we talked about major retail, but we didn't talk about independent and boutique retail, which is still a huge, huge opportunity and honestly low-hanging fruit that doesn't have some of the complexities of major retail that come with it. So we're a big fan of FAIRE, F-A-I-R-E. It's something that allows a lot of these independent boutique retailers to purchase from you at wholesale cost and stock in each of their stores. It saves you from having to go the kind of old school sales rep or showroom route that people had to do years ago. For us, I'd say, probably 50% of our wholesale revenue still comes from, independent and boutique retail.
Nice. Any more questions? All right. Here we go.
Thank you. Hey guys, my name is Suze. I wear a lot of different hats, but one of them is the venture staff at Grillo, which is a company that's actually one of the world's largest DTC investors. They billion over 7,000 plus companies. So it's changed what many DTC founders.
We're competitors, man. Take the mic away.
So I guess I heard you guys talk about kind of the macroeconomic environment changing from maybe the last 8 to 10 years till now. So I'm wondering, like, what would you tell DTC founders now that we're here right now? Are there any themes that you think they should focus on for the next 2 to 3 years? Is it particular categories? Is it category agnostic? What are kind of 2 to 3 kind of areas of interest that you would tell these founders to take a look at in terms of trying to scale their companies over the next couple of years?
I mean, this advice might be too late for many founders already have their product, but I think my main advice is like really make sure the product is right and it's differentiated and the average order value and the lifetime value and it all just like adds up and works. Because otherwise you're just gonna be trying to fit a round peg in a square hole for the next several years. And so I think that's the biggest thing is like making sure you have the right product and the product market fit before you raise money, before you go to major retailers, before you step in the gas in every single way. And I think the days where you could create a product that was mildly differentiated and hire an awesome branding agency to make it look cool and then spend on Facebook ads and build a business of several million that way, like you can't do that anymore. You need a product that's truly differentiated to everything else in the market. And so that's where I'd start.
I agree with that. I think it's, why do you deserve to exist in the world? But I also think these days it's about really redefining what healthy growth looks like, because I think so often it used to just be about top line growth and chasing that. Now it should be really about looking at your bottom line and like really going after, do you have the right unit economics? Do you have a really loyal customer base and strong retention? Because those are the things that are going to, I think, add up to successful businesses.
Any other questions for our illustrious panel?
So we have room for one more question, and then we will transition to a little break, and then our last topic. And Andrea, I know you had a question about affiliate marketing, so if you want to ask that, I'll let you go ahead, unless someone else has a question.
Affiliate marketing. Oh, I was just going to say, I was essentially going to ask that question, so the one he just asked. So I think we got to that one. But I think the point about affiliate, hearing about an influencer's request for affiliate marketing was really, really interesting. Yeah.
Perfect. All right. If you don't have any more questions, I want to give a round of applause to our amazing speakers. And some of them might be here a little bit later, so if you want to ask some questions, feel free to. So we will have a quick 5-minute transition onto the last panel, and then we just have happy hour and networking. All right, thank you guys. Thank you guys so much. Thank you. I'm really excited about the content that we got, and I feel like a lot of people are taking notes, so. Yes.